Okay. Substantive procedure for director's bonus. Obtain a schedule of director bonus and cast schedule to ensure its accuracy. Agree the amount to that disclosed in the financial statement. Review the schedule of current liabilities and confirm the bonus accrual is included as a year-end liability. Agree the individual bonus payment to post year-end payroll records. Confirm the amount of each bonus paid by agreeing to post year-end cash book and bank statement. Obtain a written representation from management confirming the completeness of director's remuneration, including the bonus. Review the disclosures made regarding the bonus paid to the directors and assess whether these are in compliance with local legislation. Substantive procedure for income of a charity. Obtain a schedule of all income and cast to confirm completeness and accuracy of the balance and agree to the trial balance. Compare the individual categories of the income against prior year and investigate any significant differences. For a monthly donation, trace a sample of donation from sign-up documentation to the bank statement, cash book, and income listing to ensure that they are recorded completely and accurately. For a sample of new donors in the year, agree the monthly sum and start day from their completed forms and trace to monthly donation received account and agree to the cash book and bank statement. Discuss with management to ensure that income received in advance has been included as deferred income and not included in current year income to confirm the cut off of income. For donation received in cash, ensure that those amounts were banked promptly to confirm that there has not been misappropriation of it. Substantive procedure for provisions. Obtain a breakdown of item to be provided for and cast it to confirm arithmetical accuracy and agree the figure to the financial statement. Inquire with the directors or inspect relevant supporting documentation to confirm that a present obligation exists at the year end. Inspect relevant board menu to ascertain whether payment is probable. Recalculate the provision and agree component of the calculation to supporting documentation to verify completeness. Inspect post-year-end bank statement to identify any payment have been made. Compare actual payment to the amount provided to assess whether the provision is reasonable to verify valuation. Obtain a written representation from management that they believe the provision is valued appropriately and is complete. Inspect the financial statement disclosure of a provision to ensure compliance with IAS 37 provision, contingent liability and contingent asset to verify classification and understandability. Substantive procedure for restructuring provision. Cast the breakdown of restructuring provision to ensure it is correctly calculated and agree the total to the trial balance. Obtain a breakdown of the reorganization provision and confirm that only direct expenditure from restructuring is included. Inspect the board menu to confirm that the decision for restructuring was made prior to the year end. Review the announcement made to the shareholders and employees to confirm that it was made prior to the year end. Review the expenditure to confirm that there are no restraining costs included. For the costs included within the provision, agree to supporting documentation to confirm validity of the item included. Obtain a written representation confirming management discussions in relation to the announcement of the restructuring and to confirm the completeness of the provision. Review the adequacy of the disclosure of the restructuring provision in the financial statement and assess whether these are in accordance with IAS 37. Substantive procedure for bank loans. Substantive procedure for bank loans. Obtain a schedule of opening and closing loans detailing any changes during the year. Cast the schedule to confirm its accuracy and agree the closing balance to the trial balance and draft financial statement. Obtaining the opening and closing loans detailing any changes during the year. Casting the schedule to confirm its accuracy and agreeing it to the financial statement and trial balance. Recalculate the interest charge and loan to ensure that the expense is automatically correct. Interest charge and loan to ensure that expense is automatically correct and the accuracy of the finance cost in the statement of profit or loss and completeness of the accruals. Review the correspondence with the bank to identify any additional charges levied. Charges, if any, should be agreed to the statement of profit or loss as finance cost. Correspondence with the bank. Reviewing the correspondence with the bank to identify any additional charges levied. Charges, if any, should be agreed to statement of profit and loss as finance cost. Okay. Obtain direct confirmation at the year end from loan provider of the outstanding balance and any security provided. Agree conform amount to the loan schedules. This will verify the valuation and right and obligation. Inspect bank confirmation letter for any loan listed that has not been included in the financial statement. To ensure completeness. Review all loan agreement for details of covenant. Reviewing all loan agreement for the detail of covenant and recalculate all covenant to identify any potential or actual breaches. Inspect the cash book for loan repayment made to verify existence and valuation. Review the adequacy of disclosure as well as the split between current liability and non-current liability and ensure its accuracy. Ensure it is in accordance with accounting standard and local legislation. Substantive procedure for redundancy cost. Review the board minutes for evidence of a decision to make the particular department redundant was taken prior to the year end. Substantive procedure for redundancy cost. Review the board minutes for evidence of the decision to make particular department redundant was prior to the year end. Review the announcement made to staff member to confirm the redundancy was announced to them prior to the year end. Obtain detail of the redundancy calculated, cast the schedule and agree to the trial balance of financial statement. Recalculate the redundancy provision to confirm completeness and agree component of cost to supporting documentation such as employee contracts. Review the post year in period to identify whether any redundancy payment have been made. Compare actual payment to the amount provided to assess whether that provision is reasonable. Obtain a written representation from management confirming the completeness of the cost. Review the adequacy of the disclosure relating to redundancy provision, relating to the redundancy provision included in the financial statement, and ensure it is in accordance with IAS 37 provision, contingent assets and contingent liability. So first one is announcement, whether the announcement was made prior to year end, and then redundancy. Review board minutes. Board decisions was made prior to the year end, and the announcement to the staff was made prior to the year end, and redundancy calculated should be compared with trial balance and financial statement. And redundancy provisions is we have to calculate the redundancy provision, recalculating it, and to confirm whether it is complete or not, and we have to agree those component of cost to the supporting supporting documentations. Review the post-year-end period to identify whether any redundancy, and we have to check that post-year-end period to check whether any redundancy payment has been made or not. And the actual payment, we have to compare between the actual payment made and the provision, whether those two are reasonable or not. And we have to take management representation later regarding the completeness of the cost. And as per IS 37, whether the disclosure made regarding the redundancy provision is adequate or not, we have to check, we have to review that as well. And substantive procedure for vehicle addition and disposal. So obtain the schedule of addition to vehicle and cast it to agree. Schedule of addition to vehicle and cast it and agree the total to the disclosure note for property, plant and equipment. Inspect the non-current asset register to ensure that new addition have been included correctly, and the disposal have been removed from the non-current asset register. Okay. Third point, recalculate the gain or loss on disposal and agree to trial balance and statement of profit or loss. Inspect supporting documentation to ensure that company owns the new vehicles. This will test for right and obligation. Okay. Recalculate the depreciation expense and ensure that depreciation is charged on disposal only till the date of disposal, and on addition only from the date it was made functional. Review the notes to the financial statement to ensure that the disclosure of the addition and disposal is in accordance with IS 16, property, plant and equipment. At first, we have to obtain a schedule of additions of vehicle. How many additions was made? Those schedules we have to get, and we have to check it with the total disclosure for the note for property, plant and equipment, whether it is matching with the property, plant and equipment or not. Then we have to check the non-current asset register. In non-current asset register, we can check the full list of the detailed. It includes detailed list of the assets since opening plus addition minus disposal, whether those new addition has been included correctly or not. We have to check that, and whether the disposal have been removed or not. That also we have to check that, as well as in case of disposal, there will be loss or gain, whether it has been appropriately shown in profit or loss, and it is agreeing as per to the trial balance or not. We have to recalculate that. And regarding owning the new vehicles, whether actually the company is owning the vehicle or not, we have to check that. For that, we have to check the supporting documentation, purchase invoice, vehicle registration, etc. This will test for rights and obligation. Recalculate the depreciation expenses and ensure that depreciation is charged on disposal only till the date of the disposals. For depreciation expenses, till the date of disposal, the depreciation should be charged, and after that it should not be charged. Okay. And an addition, when the depreciation should be calculated starting from the date it was functional, when it came to use. From the using date, it should the depreciation should be added. And reviewing the notes to the financial statement to ensure that disclosure of the addition and disposal is in accordance with IS 16. Substantive procedure for addition of non-current asset. Obtaining a breakdown of asset additions, cast the list and agree to non-current asset register to verify completeness. Select a sample of addition and agree cost to supplier's invoice to confirm valuation. Inspect the list of additions and confirm that they relate to capital expenditure item rather than repair and maintenance to verify existence. Inspect the repairs and maintenance account in general ledger for item of capital nature to verify the completeness. Inspect supplier invoice, title deeds and registration document to ensure they are in the name of the client to verify right and obligation. If the asset has been constructed by the client, obtain an analysis of the cost incurred. Cast for arithmetical accuracy and agree a sample of cost to supporting documentation, payroll material invoices to verify valuation. Okay. For solving the substantive procedures questions, we need to know the assertions. There are assertions for all the assets, like all the item of financial statement: assets, liability, income and expenses. For assets, the assertion is existence, asset and liability. The key assertions are existence, right and obligation, completeness, valuation and allocation. So uh, when there is a question relating to non-current asset, substantive procedure for addition of non-current asset, then we have to remember the assertion. The common thing is assertions, that is existence, whether that addition is existing or not. For that we have to whether that is existing or not, and then whether it is complete or not, whether we have completely recorded it or not. For the non-current asset, whether we have completely recorded all the additions or not. Now, whether we have allocated it properly or not, whether for existence, like whether all the capital expenditures are included in the non-current assets, and all the revenue nature expenses are included in the profit or loss or not. So for that we check repair and maintenance expenses, like whether there is any capital nature expenses related to or not. If there is, we have to reallocate it to the non-current assets, and if there is any expense nature of spending that has been capitalized, then we have to reallocate it to profit or loss in repair and maintenance or other appropriate hits. Okay, and this which for rights and obligations, like whether to verify the right relating to the non-current asset, we need to verify supply invoices, title deeds, registration documents. So to verify its valuation, we need to asset has been constructed. To verify its valuation, we need to check its cost. All its directly attributable expenses are included in it or not. Substantive procedure for valuation of trade receivable. Okay, we have to review the aging receivables listing to identify slow moving or old balances. Discuss the status of these balances with the credit controller to assess whether the customers are likely to pay or if an allowance for receivable is required. First and foremost, for trade receivables, we have to check that whether we have to check the aging reports, whether there is any old balances that is still pending to be received or any slow moving items, and then we have to check whether there are any after date cash receipts for slow moving or old receivable item. We have to, in order to verify that the receivable is true or not, whether it will be received or not, whether we can show it as receivable or not. For that we can check the confirmation from the client as well as subsequent receipts, like post year in receipts would be there, that Okay, and review the correspondence with the customers in order to identify any balance which are in disputes or unlikely to be paid. Now, correspondence customer in order to identify any balances which are in disputes, or if there is any balances which are in disputes which is not matching as per our books and as per the customer's book, or unlikely, and which are not likely, or which are not likely to be paid, or for that we have to discuss with management whether any allowances is required or not. Review board minutes. We have to review the board minutes to identify whether there are any significant concern in relation to outstanding receivables. We have to review the board minutes to identify if there is any significant concerns in relation to outstanding receivables balance, and assess whether the allowance is reasonable. Okay, inspect the post year in sales return. If there is any sales return after the year end, there is any sales return, credit notes, and consider whether an additional allowance against the receivables is required. Obtain a breakdown of all allowance for trade receivables. Regarding the trade receivables, we have to check the allowance breakdown and recalculate it and compare it to any potentially irrecoverable balance to assess if the allowance is adequate. Breakdown of the allowance for trade receivables. For trade receivables, we have to obtain the breakdown for allowances as well. We have to recalculate it and compare it to any potentially irrecoverable balance to assess if the allowance is adequate. Okay. Substantive procedure for potential breach of regulations. For potential breach of regulations, what are the substantive procedure is? First, we have to review the correspondence with relevant authority to establish details of the complaint and the number of times the breach has allegedly occurred. Review the correspondence with relevant authority to establish if there has been discussion about other instance of potential non-compliance. Review the correspondence with legal advisors, or with the client permission, contact the lawyer to establish their assessment of the likelihood of the breach being proven and any fine that would be payable. Reviewing the board minutes to ascertain management view as to the likelihood of an outflow of the funds. Obtain a written representation to the effect that the directors are not aware of any other breaches of law or regulation that would require a provision or disclosure in the financial statement. Inspect the post year in cash book and bank statement to identify whether any fines have been paid.